making a move. At expiration, if both options are out of the money and have no market value, you'll realize the maximum profit. Again, this situation should occur if the underlying stock closes at any amount below the lower strike price with no action needed on your part. What about realizing maximum profit before expiration? You may find that a bear call spread has no value or very little in advance of expiration if both calls are far out of the money. If you want to close out the spread and realize your profit potential at this point, you'll need to buy it in the marketplace. In reality, you won't be able to buy the spread for no cash. Why? Would you or anybody else be willing to sell a spread or any other option for nothing with no profit potential for its remaining lifetime? If it looks as if a bear call spread is going to expire in the money, that is when the underlying stock price above the higher strike price, then you might choose to do nothing and let the exercise and assignment process generate the maximum loss you expect. In this situation, you can exercise the long call and buy shares at the higher strike price, and at the same time, expect assignment on the short call and sell those shares at the lower strike price. You'll see a gross loss per share equal to the difference in the strike prices. However, you received a credit when the spread was established in the first place, so your net loss would reflect the formula for maximum loss. Maximum loss equals the difference between strikes minus credit received. With the June 60.55 call spread, you'd exercise and buy 100 shares at the long call strike price of 60. Be assigned and sell 100 shares at the short call strike price of 55 and see the $500 loss. However, you originally received a $350 credit for the spread, so your net loss would be $150. $500 minus $350 equals $150, or the maximum. At expiration, a bear call spread may be partially out of the money. That is, the underlying stock closes between the spread strike prices so that only the lower or short call is in the money. In this case, if you don't want to risk assignment, you might just close out or buy the short call for its market value and let the long call expire with no value. If you can buy the short call for less than the credit you received from the whole spread, then you'll see an overall profit for the position. If you buy it for more than the spread's credit, then you will see only a partial loss. As expiration approaches and a bear call spread is at least partially out of the money, you should begin to think about whether to let the spread expire and exercise and assignment process begin, close out the spread by buying the whole thing, or the short call part of it, if appropriate, in the marketplace. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.